Okay, welcome to the next class, and we get a welcome relief from financial instruments. We go to the next standard, which is IND 33. It's an important standard on EPS, a tier 1 category standard in terms of its importance. So have we done a separate standard on these lines? Well, yes, we have. Hopefully we have. In our interCA, we have done AS20. So this standard is on similar lines, but we will do a lot more complex problems and also apply a lot of our understanding on financial instruments and other items over here as well. So when we look at EPS, why is EPS such an important number that it dedicates an entire standard? Because a lot of financial performance ratios and measures are linked to EPS. Most important among them would be the PE ratio, the price to earning ratio. In fact, EPS is like a bridge between your company's performance and the company's market price. So the ratio that connects your company's performance with the company's market price is actually the PE ratio, the price to earning ratio. So for example, the PE ratio of your company is 10 times and your EPS is 15 rupees. Then your price is 15 into 10, that is roughly 150. All else remaining constant, if your EPS, you manage to do business in a way that you increase your sales, you reduce your cost, and as a result your EPS goes up. All else remaining constant, if your EPS becomes 20, then your market price will become 20 into 10 times the PE ratio, and hence 200. And hence EPS provides that direct bridge between your company's financial performance with the company's market price performance. And hence it is such an important number that the standard mandatorily requires you to show this on the face of the income statement. So at the bottom of income statement of companies that you audit, you will see EPS being shown. And EPS is of two types over here. There's something called as a basic EPS, and then there is something called as a diluted EPS. What do we mean by basic EPS? Basic EPS is the earnings per share, where shareholders are like the ordinary shareholders. We are not looking at all components of equity. It is earning per share, not earning per equity, which means there may be various other items within equity like irredeemable debentures, or there may be capital contribution from parent. No, we are looking at earning per equity share, per ordinary share. And as a result, you would want to know that how much is the earning that each ordinary shareholder or equity shareholder is getting from the company's performance. Okay. When you look at diluted EPS, and we'll do that probably in the next class, when we look at diluted EPS, then diluted EPS looks at the earning per ordinary as well as potential share. What do you mean by potential share? Potential shares would include those shares which have the potential to become equity shares, like convertible debentures or bonds as a case. Maybe we will study that once we reach diluted EPS, but first the focus should be on basic EPS. Now, how do you calculate basic EPS? Well, earning per share, and hence in the numerator you will take the profit available for equity shareholders. So the profit available for equity shareholder has to be deducted after paying off all expenses like salaries, wages, rent, advertisement, after all expenses. In fact, it has to be after all payments, let's say to other providers of capital as well, because equity shareholders get the money last, which means it has to be after the deduction of preference dividend, interest on bonds, and even payment of government taxes. After that, whatever is the pool of money which is remaining, that pool of money is belonging to the ordinary shareholders. Acha. And hence the net profit attributable to ordinary shareholders will be after deducting all expenses, considering all incomes, and then you will divide it by shares. That will typically give you the basic EPS. Now the challenge over here is the numerator, when we look at, is the net profit for shareholders, which is a for the year concept. So net profit can be earned throughout the year. However, the number of shares is typically calculated as on a particular date. So the number of shares at the beginning of the year may be different from the number of shares at the end of the year. And as a result, this may result in a bit of confusion. So for example, there's a company A, there's a company B. Both of them during the year 2010-11 have earned a profit after tax which is attributable to equity shareholders of, let's say, 1 lakh rupees. Now company A had equity shares from 1st April 2010. It had 10,000 shares and there was no further issue. Company B had only 1,000 shares on 1st of April 2010, but on the last day of the year, let's say on 31st March 2011, it issued another 9,000 shares. And as a result, if you go to see, the total outstanding shares becomes 10,000 for company A, becomes also 10,000 for company B. If I try to calculate the basic EPS, taking the shares as on a particular date, it will appear that the basic EPS for company A equals 10, while basic EPS for company B also equals 10. Now that might be fundamentally flawed because on reading it might appear that company A and B are similar in terms of their earning performance. Now as a matter of fact, if you have more capital, you can generate more earnings. If you have lesser capital, you can generate less earnings. Company B had 1000 shares for almost the entire year except for the last 1 day or so where it had another 9000 shares. It had 1000 shares for the entire year. Whereas company A had 10,000 shares, and as a result, it might be appearing that both companies have earned 1 lakh rupees, but company B has earned at 1 lakh on a much lower capital base as compared to company A, and that should be reflected through EPS. And hence, what we try to do is a time value adjustment. We are trying to study the denominator in the basic EPS calculation. The denominator in the basic EPS calculation is something called as VANES. What is the full form of VANES? The weighted average number of equity shares, where you are trying to find the number of equity shares that are outstanding throughout the year and not as on a particular date. Why, sir? Because in the numerator you have the net profit which is earned throughout the year. So in the denominator also you should look at the number of shares which are outstanding throughout the year. So over here there are various ways in which it can be calculated. So let's say 1000 shares, we can say, let's say for company B, are outstanding for the entire 365 days in a year. However, the remaining 9000 shares are outstanding only for 1 day, and as a result, if I were to calculate the VANES over here should be 1000 plus the time weight. So this is 9000 divided by 365 m plus, which is around 24.66. so over here you can even take this in decimals, that is fine. So this is 1066 or 1024.66. This will be your weighted average number of equity shares, and hence if I were to calculate the basic EPS for company B, it would be rupees 1 lakh divided by 1024.66, and that would be a much higher EPS, and that would correctly reflect, so this is 97.59, so this should correctly reflect the fact that company B is almost a 10 times better company than company A, and not almost the same. This can be done by taking the weighted average number of equity shares. Achha, this is one way where you are taking the number of days at which each share was outstanding. Alternatively, you can also divide the year into various parts, where you can say that, well, for 364 days in a year, out of 365 days, there was 1000 shares outstanding, but then for 1 day in a year, there was total 10,000 shares outstanding. So here, instead of taking each share separately, you are taking the cumulative shares. Your answer will be the same though. So this is 1000 into 364 upon 365 m plus, and 10,000 into 1 divided by 365 m plus, and if you total, it is 1024.66, exactly the same number. Whatever you are comfortable you can do, though most of the times ICAI takes each share separately. Having said that, you can also take the cumulative shares, whatever is comfortable. Okay, so there is an example which is there in your shield for the VANES calculation. We'll try to do that. So over here we have on page number 68, we have basic EPS, which is calculated as a net profit attributable to equity shareholders upon the weighted average number of equity shares. Okay, numerator we will study. We are first trying to figure out what is the weighted average. Well, weighted average number of shares should be calculated as a time based weighted average, like we took the number of days as the base, where the number of days or months, as the case may be, for which shares are outstanding are taken as weights, based on which you have this example over here, an example of VANES. Your opening shares are let us say are 2 lakhs, which is outstanding. Let's say if I take months for the entire 12 months, you can even take days. Fresh issue of shares is happening at fair value. So new shares are issued on 30th June, and hence they will be outstanding for 9 months. On 1st of December, conversion of preference shares. When preference shares are converted, the journal entries preference share capital account debit to equity share capital. Basically, new shares are issued, which is outstanding for 4 months in a year. But then there is a buyback. If a buyback happens, the number of shares outstanding will reduce. But the buyback is happening on March, and hence the time weight attributable to buyback will be 1. And as a result, if I were to find weights, we can say 2 lakh shares are outstanding, let us say for the entire 12 months, plus another 50,000 shares are issued which are outstanding, let us say for 9 months, plus another 20,000 shares are issued which are outstanding for 4 months. However, some of these shares have been bought back. So basically 30,000 shares have been bought back, and that is to be reduced because they are bought back for 1 month. And as a result, this will be 2 lakhs M plus 50,000 into 9 by 12 M plus 20,000 into 4 by 12 M plus and 30,000 divided by 12 M minus, and hence this is 2 lakh 41,667. This can also be calculated by dividing the years into various parts like we did. So you'll have 2 lakhs for 3 months. After that, your total shares becomes 2 lakh 50 for another 5 months till November. Then your total shares becomes 2 lakh 70 for December, January, February, another 3 months, and then it becomes 2 lakh 70 minus 30, that is 2 lakh 40 for another 1 month. You will still get the same answer, and in your EPS you have to take 2,41,667, which is calculated taking the time as the weight. Now, is it possible that you might issue partly paid up shares? Well, yes. In case there are partly paid up shares, what might happen is they may not be again truly comparable. There might be a company A, company B. Let us say the profit is 1 lakh. Now, if I look at the number of shares, company A might have 1,000 shares of rupees 10 each, which are fully paid. Company B might also have 1,000 shares of rupees 10 each. However, it is only rupees 2 paid. In which case, if both the companies have managed to generate a 10,000 profit, as a matter of fact, company B has managed to generate it with much lower capital base. No, sir, number of shares was same here. The number of shares might be same, but these shares have given you a much lower capital of only 2 rupees. Whereas for company A, the capital given is much higher. Then what does the standard say? The standard says you will have to convert this into equivalent number of fully paid shares. So over here this is 1000 only. However, we can say that 1000 shares have given you rupees 2. That is, they have given you rupees 2000. Had you issued fully paid shares, then you would have received rupees 10. And as a result, 1000 into 2 divided by 10, which will come to 200 shares. So when you look at your EPS calculation, you will do 10,000 divided by 1000, and as a result this will come to a basic EPS of 10. However, here you do 10,000 divided by only 200, and as a result this shows a much better performance, let us say at rupees 50, which is correct. So partly paid up shares will be converted into equivalent fully paid up shares and then used in the basic EPS calculation. Okay, then you go to shares issued without consideration. Sir, do you issue shares without consideration? Well, yes. Typically, the examples for this would be bonus shares or share split or a reverse share split, as the case may be. These are shares which are issued without consideration. So how do we calculate EPS, and why are they different from shares which are issued for consideration? So for example, you have, let us say 2009 and 2010. Let us say the PAT in these years has been 1 lakh. Now, in both of these years, let us say your number of shares outstanding are 10,000, which means the basic EPS is 10 rupees, and hence they are comparable. However, let us say let's say this is a calendar year. Let us say on 1st of January 2010, the company ended up issued a 1:1 bonus, which means what will happen is, for the year 2009, we will still say that we have 10,000 shares. However, for the year 2010, we will say that we have 20,000 shares. And as a result, if I were to calculate the basic EPS, the basic EPS over here will be 10, over here will be 5. A reader of the financial statement will assume that the company's performance has become half. Yes, a talented person like you would look at the notes to accounts and figure out that there was a bonus issue because of which the number of shares are greater. However, as we have always mentioned, financial reporting means how the numbers are reported. A lot of investors don't have the time to go through the entire annual report, and they will make a conclusion based on what they see on the face. Like you would make a conclusion based on what you see on the headlines of a newspaper. In a similar way, a decision might be taken by investors looking at the face of the income statement. And on the face of the income statement, it shows a fall in performance. So barabar hai na, if with more shares you are still earning the same profit, there is a fall. Well, this would have been correct provided these 10,000 shares that you issued as bonus shares came for a consideration, which means you received more capital and still you are earning 1 lakh. Yes, then that is poor utilization of capital. But when you look at a bonus or a share split, you don't really receive even a penny more. In fact, the journal entry is reserves account debit to share capital or share capital account debit to share capital, as a case may be, in which case it is just a book entry. There's not even a single penny which comes additionally in the company, and hence it is wrong to say that the company's performance has remained half. At best, you can say that the company's performance has remained the same, because bonus is just a book entry. Then what do we do, sir? Well, the standard says you do a retrospective restatement. Sir, how can we retrospectively restate? In the last year, we have already reported in our annual report an EPS of 10. Perfect. No one is telling you to go and change your regulatory filings of the last year. What has been reported and filed and sent, that will go as it is. However, most of the investors, when they compare the current year's performance, they don't really go and open the last year's annual report. Some of them might, but you can't do much about that then. But they look at the previous year's column in the current year's annual report. So when they look at the previous year's column, why not assume that these bonus shares were there from the very first day? Sir, but ऐसे कैसे assume कर सकता है? करने में नुकसान क्या है? Did bonus shares give you even a single rupee more? No. And as a result, whether the bonus shares were issued on 1st of January 10 or 30th of March 10 or even 1st of January 2009, how does it matter? These are shares issued without consideration, and hence bonus shares will be retrospectively restated from the earliest reported date. If you are preparing 5 years at a glance, then the first date of the 5th year, the earliest reported date, we will assume that the bonus shares were already in existence, assuming the shares on which bonus are given are in existence at that point. So over here, we will assume that the deemed date of bonus is not 1st of January 2010, it is actually 1st of January 2009. It is the earliest reported date, in which case if the bonus had actually been given on 1st of January 2009, then there would be 20,000 shares over here, and hence the restated EPS. Restated EPS means the EPS in the current year, which is appearing in the comparative, will be 5 rupees. And if you compare 5 and 5, it gives you a fair judgment on the performance. A lot of students argue that why are we adjusting the past year? Why can't we ignore the bonus issue, and why can't we show this as 10,000 only? For one, your market price would have adjusted because of bonus. So if your market price was 1,000, it would have now become, bonus ke wajah se it adjusts, if you are aware, it would have become 500. So if you calculate a PE ratio is calculated by comparing the market price, which today is after bonus, with the EPS, which then ideally for comparability should also be after bonus. And hence we said the current situation is the company has given a bonus, and as a result that should be reflected. But for a better comparison, we will assume that the bonus shares were always in existence. In fact, the standard says that you can calculate what you call as a bonus ratio. How do you calculate a bonus ratio? A bonus ratio is calculated by taking the number of shares which are pre-bonus, which can be, let us say, 1 share, plus the number of share of the bonus, that is also 1 share, divided by the number of share pre-bonus. Basically, in the numerator, you are taking the post-bonus number of shares. In the denominator, you are taking the pre-bonus number of shares. This will help you in calculating the bonus ratio. Certain times the bonus ratio may not be given. However, you can calculate this. Acha, theek hai, humne calculate kiya. So what do we do with this? Well, you can multiply the bonus factor. Multiply the bonus factor to each share which is outstanding prior to the date of bonus, prior to the actual date of bonus. Sir, what is the significance of this? For example, I'll give you an example over here. Let us say on 1st of January 2010 there were 10,000 shares outstanding. Then on 30th of June 2010, let us say, please pay attention, you issued 5,000 more shares at the rate fair value. This is not bonus shares. Okay. Then on 1st of January 2011, you issued bonus shares which are in the ratio of 1:1, that is 15,000 bonus shares. And then on 30th of June 2011, you issued another 5,000 shares at the rate fair value. Now the question says you calculate VANs. So over here, when you are calculating VANs for the year 2010, for the purpose of restated EPS, one can say that, well, let us assume the bonus was issued from the earliest reported date. Let us say on 1st of January 2010. If the bonus was issued, then against these 10,000 shares, another 10,000 shares will be issued as bonus, bang on. And on these 5,000 shares, another 5,000 shares would have been issued as bonus shares. Perfect. However, you have to remember that these 5,000 shares were outstanding only for 6 months in a year. You can't assume that the 5,000 bonus shares on these 5,000 shares would be outstanding from the very first day. Sir, why not? Can a child come before a father? Bonus share is like the child, your original share is like the father. In which case, the shares which are 5,000 shares which came into existence on 30th June 2010, how can the bonus shares on these shares be in existence from 1st of January? Impossible. The earliest date when bonus can be effected on these shares, hypothetically, is from the date of their issue. And as a result, we would say that VANs over here would be, well, for these 10,000 shares, we can multiply the bonus factor into 2/1, and these shares were outstanding for the entire year. However, the 5,000 shares were outstanding for only 6 months, and hence 2/1 hoega. But then the 5,000 original shares were also outstanding for 6 months. If a bonus, it is like saying the shares were issued and bonus was given on the very same day, then bonus shares will also be outstanding for the 6-month period. You can't have bonus shares to be outstanding for 12 months when the original shares themselves were outstanding for only 6 months. And as a result, over here, you will have 20,000 into 12/12 plus 5,000 into, let us say, 2 into 6/12, which is come to 5,000. And hence, your weighted average number of shares, and we'll do this in a sum as well, will be 12,500. Okay, the similar logic will also be applied in the year 2011. In 2011, what is happening is you have 15,000 shares at the beginning, on which you can apply 2:1 bonus into 12/12. Now, अपन क्या करेंगे, लगे हाथ, चलो, on these 5,000 shares also, you will apply bonus ratio. Why? These shares are issued after the date of actual bonus. The bonus shares are maximum 15,000. The next 5,000 shares, which are issued on 30th of June 2011, are issued after the bonus is given, and hence they are not even eligible for the bonus shares. So, यहाँ पे directly into 6/12 आएगा. So, this will be, let us say, 30,000 plus 5,000 into 6/12, which is 2,500, and hence 32,500. So this is how you will calculate VANs. We'll understand this better with the help of an example. So we'll go to questions 1, 2 and 3. Go to your volume number 1, please, on page number 120. Let us go through these questions. Okay. An entity issues 1 lakh ordinary shares of ₹1 each, okay, for a consideration of 2.5. So for every share you should be receiving 2.5 rupees in total. A cash of 1.75 has been received and till the balance sheet date. The partly paid shares the partly paid shares are entitled to participate in dividends for the period in proportion to the amount paid up. So the dividend that you are going to get is in proportion to the amount paid up. If you have not paid up the entire amount, so they have paid only 1.75 as compared to 2.5, they will not get the full dividend. Okay. Calculate the number of shares for the calculation of basic EPS. Well, you will have to take equivalent number of shares. That is 1 lakh shares have given you rupees 1.75. However, if they were fully paid shares, they would have given you rupees 2.5. So how many shares does that translate into? So this would be 1 lakh into 1.75 upon 2.5, which is 70,000. So over here this is 70,000. So these are 70,000 equity shares which will be taken, 70,000 equivalent fully paid up equity shares which will be taken in your basic EPS calculation. That is question number 1. Okay, next we go to question number 2. This is on bonus. So question 1 was on partly paid shares. Question 2 is on bonus. Question 3 is also on bonus. 3 you can mark as important, but pehle 2 finish kar lete. On 31st March 2012, the issued share capital of the company consisted of rupees 1 crore in ordinary shares of rupees 25 each. So 1 crore in ordinary shares of 25 each. So that means that must be 1 crore hai ya 10 crore hai, kya hai ye? 10 crores lag raha hai nahi? So this is 10 crores I guess. So this is 10 crores, I'm sorry. 100 million or 10 crores, it kya time pass hai, divided by 25. So this is 40 lakh shares. So basically you'll have 40 lakh equity shares and rupees 5 lakhs in 10% cumulative preference shares. Achha, cumulative preference shares, unless given otherwise, preference shares are redeemable, and since the dividend is cumulative, these preference shares are in the nature of financial liability. Okay. Of rupees 1 each, which means there are 5 lakh preference shares. On 1st of October 2012, the company issued 1 million or 10 lakh ordinary shares fully paid up by way of capitalization of reserves. Capitalization of reserves is also called as bonus. Bonus can enter the reserves account debit to share capital, so that is capitalization of reserves in proportion of 1:4 for the year ended. 1:4 yani kaise? For every 4 old shares, you have 1 new share. So this is 40 lakhs into 1/4 will come to 10 lakhs. Okay. For the year ended 31st March 2013, profit over here write down before deducting preference dividend into bracket, just add this, it is not printed, before. या फिर एक बार अपने सोल्यूशन में देखते हैं क्या लिखा हुआ है उसके हिसाब से. This is after, so let's clarify and say this is after, I'm sorry, this is after deducting preference dividend. सर वो तो नहीं भी दिया रहता था, अपन अज्यूम करते थे yes because preference dividend is a financial liability, and if it is a financial liability, the preference dividend over here is a finance cost. It is not an appropriation, and hence when the word net profit is given, the word net profit is always after deducting finance cost, and hence preference dividend must have already been deducted. But better to clarify. So this is after deducting preference dividend for the year 11-12 and 12-13 is 4,50,000 and 5,50,000 respectively. Calculate the basic EPS for the year 11-12 and the year 12-13. So over here, if you go to question number 2, in which case you have 11-12 and you have 12-13. Aja, we are first trying to find the basic EPS, for which we'll have to find the veins. Well, basic EPS is earnings per equity share. So preference shares will not come in the denominator, equity shares will. And hence the profit that you should have is a profit after deducting preference dividend, which is a case. So this 4,50,000 or this 5,50,000 as a case maybe is a profit after deducting preference dividend. Now there has been a bonus issue of 10 lakh shares. When will you assume that these 10 lakh shares are outstanding? We'll assume that these are outstanding from the very first day. or from the date of issue, as the case may be. So over here you will try to find a bonus ratio. Sir, is it compulsory to find a bonus ratio? No, but it is advisable. So bonus ratio is the number of shares pre-bonus, so 4 shares, on which 1 share is given as bonus, so 4 plus 1, that is equal to 5, upon the number of shares pre-bonus, which means if you have 4 shares pre-bonus, it will become 5 shares post-bonus. So over here you will multiply this to the number of shares which are outstanding prior to the date of bonus. Prior to the date of bonus, there was 40 lakh equity shares outstanding, on which 5 by 4 you will multiply, and this was outstanding for the entire year, so into 12 by 12. Same is the case over here. Certainly the bonus was issued on 1st of October, does not really matter. We'll assume that the bonus is issued from the very first day. So this is again 40 lakhs into 5 by 4 into 12 by 12. So this is 4 lakh 50 upon, this is, let us say, 40 lakhs into 5 divided by 4, which is 50 lakhs. This is your restated EPS. If you actually open the annual report of the last year, your EPS would be calculated based on 40 lakhs only. However, this will be 4 lakh 50 divided by 50 lakhs, which is 0.09. Is this correct? .09. This is the restated EPS, meaning in the current year's financial, when you look at the comparative column, this is what will appear. The reported EPS, for your understanding, would have been 4 lakh 50 divided by 40 lakhs, would have been 0.1125. That would have been the reported EPS. Over here, this is 5 lakh 50 upon, again we will have 50 lakhs, and hence this will come to, I think, 0.11 if I'm not wrong. So 5 lakh 50 upon 50 lakhs is 0.11. Okay, perfect. So this is question number 2. 3 you will mark as important, so you will write 0.3. So let us find the working in question number 3. This is something that you should revise. Question number 3. Aja, X Limited on 1st of January has 10 lakh shares in issue. On 28th February, that is 2 months later, it has issued 2 lakh shares. This is at fair value, which means it is for consideration. On 31st of August, it issued bonus shares as 1 for 3, which means if I were to find a bonus ratio, the bonus ratio would be, well, post bonus, for every 3 shares you will get 1 share, whereas pre-bonus this was 3, so this is 4 by 3. The bonus ratio is 4 by 3. On 30th November, we issued 2,50,000 shares at fair value. So this is issued 2,50,000 shares, let us say, at fair value. Calculate the number of shares which would be used in the basic EPS calculation. Consider the reporting date as 31st December. So we just have to find the veins where the number of months for which shares are outstanding should be taken as weights. However, while doing that, you will have to make the bonus adjustment as well. So we can say that the first 10 lakh shares as such are outstanding for the entire 12 months. However, these are shares which are outstanding prior to the date of bonus, and hence we will be eligible to receive bonus shares on this, which we will assume are outstanding from the very first day. So this is into 12 by 12. After that, on 20th February, that is after 2 months, another 2 lakh shares have been issued. These are also shares which are issued prior to the date of bonus, and hence even on these shares you will be eligible to receive bonus, though these shares were issued in February, and hence they will be outstanding only for 10 months. If these original shares are outstanding for 10 months, the bonus shares on them will also be outstanding at max for 10 months only. After that, as such, you will have bonus shares. But when we do a 4 by 3 adjustment over here, basically total bonus shares अगर आप देखने चाहो तो 10 plus 2, that is 12 lakhs. 12 lakhs into 1 by 3, that is 4 lakh bonus shares. But if you go to see, when we do 10 lakhs into 4 by 3, loosely speaking over here, you have 10 lakhs into 4 by 3 m plus, and 2 lakhs into 4 by 3. we are ignoring the time value adjustment for the timing, into 4 by 3 m plus will give you 16 lakhs. So basically 10 plus 2 and then 4 lakhs of bonus. 16 lakhs are 10 plus 2 plus 4 lakhs of bonus, which has been considered when you do the 4 by 3 ratio adjustment. You don't have to add the bonus shares separately. When you do the bonus ratio adjustment, the bonus shares are already added. The bonus shares on 10 lakhs are already added along with 10 lakhs, and the bonus shares on 2 lakhs are already added along with the 2 lakhs. Acha. However, when we look at, let us say, the last installment of 30th November, you issued another 2,50,000 shares. Are these shares going to be eligible for bonus? No, and hence the 4 by 3 adjustment will not be done over here. It will be done only for those shares which are eligible for bonus. And these shares will be outstanding. Let us say these are issued on 30th of November, so they will be outstanding for 1 month. So into 1 by 12, and that will finally give you, so this is 10 lakhs into 4 divided by 3 into 12 by 12, 2 lakhs into 4 divided by 3 into 10 by 12, and 2,50,000 directly divided by 12. So if I total this up, this is I think 15,76,388 or 389 as the case may be. So I hope that takes care of your understanding. We have also given an explanatory note where we have said that bonus shares on the 2 lakhs cannot be assumed to be outstanding for the entire year, because 2 lakhs itself was not outstanding for the entire year. Then the bonus on that cannot be outstanding realistically for the entire year. Acha, the next, so we can even read the theory for this once on our shield. So we have done point 1. Point 2, partly paid up shares, we should convert them into equivalent fully paid up shares and include them in the Wayne's calculation like you did in question 1. And then point 3, shares without consideration, which can be bonus or split. These shares are issued without consideration and hence should be retrospectively adjusted from the earliest reporting date, that is the first date of the earliest period reported, if the shares are outstanding. The actual date of bonus issue is actually irrelevant. We typically do the bonus adjustment by finding a bonus adjustment factor, that is the total shares post bonus upon the number of shares pre-bonus. The bonus adjustment factor should be multiplied to the number of shares issued before the date of bonus. No adjustment should be done separately for the bonus shares, for which we have done 2 and 3. Now comes rights issue. Now rights issue is actually a share issue for consideration. Then why are we studying this separately? Let us say the current market price of the company, let us say what we call as cum rights, which is including the benefits of right. This is before the share goes X right, is let us say 150. The rights issue price. So the company has announced the rights issue, but the company is not yet allotted right shares. So let us say the rights issue price is 100. So apparently there's a discount of 50 rupees. And the rights ratio is let us say 1:4, which means for every 4 shares that you're holding, the company is going to give 1 right share. Aja. So over here, what are the pre-right shares? Let us say the pre-right shares are 10,000. Therefore, the company will end up issuing, as a part of the rights issue, 10,000 into 1 by 4, and hence the company will end up issuing, I guess, 2,500 right shares at the rate of 100 rupees. Now, when we look at the fair value prior to rights, this is also called as the cum rights price or the fair value prior to exercise of rights, which means the company has already announced the rights issue, and if the rights issue is favorable, the company's market price has already gone up. Like in your interest, if you remember the cum dividend price and ex dividend price, once a company announces that it is going to pay the dividend, dividend is paid to shareholders who are holding the shares on the record date. So once a company announces that it is going to pay a dividend, the company's market price is going to go up because the shareholder who is selling the share before the record date is giving up the share as well as the right to receive dividend. In a similar way, a shareholder who is selling the share prior to the record date is giving up the share as well as the right that he is entitled to subscribe to the shares at a discounted price. Okay, so typically, let us say if these right shares are issued, let's say the company has a calendar year, then if these are issued on 1st of July 2011, whereas these were outstanding from 1st of January 2011, and let us say the year ending is 31st December 2011, typically if I were to calculate the veins would be, well, 10,000 shares are outstanding for the entire year, so into 12 by 12 plus 2,500 shares are issued for consideration. However, the consideration is not the full value, but nevertheless they are issued for consideration and into 6 by 12, and this would give you veins. Now the problem over here is, since the right shares are issued at a discount, the bonus are also issued free of cost. So bonus is also technically issued at a discount. जितना भी share का price है उतना अपन discount दे दे रहे. Here you are giving some discount. Here you are giving a discount of 50. कल उठ के you can also do a rights issue at 1 rupee. In which case there's a huge discount. So what we want to understand is that does the right share have a hidden bonus? The answer is yes. I'll try to conceptually build it up, though it is a little difficult to understand. What we do is we have to calculate what is called as the theoretical X rights price. How do you calculate the theoretical X rights price? Typically this is calculated as a weighted average price, where we are looking at how much value would a shareholder invest for subscribing to the shares as well as the rights. Well, if I want to subscribe to the shares, and this is what the institute does, and rightly so, I'll have to buy 4 shares at 150 rupees each. That is when I will get the ability to subscribe to one right share. One right share will not come free of cost. I'll have to pay 100 rupees, against which I will get one right share, which means for a total of 4 plus 1, that is 5 shares, I've ended up spending 600 plus 100 for 5 shares, and hence 700 divided by 5 will come to 140. Acha, if you have done your SFM and if your concepts are good, how do you find the X bonus price, or how do you find the X rights price? Conceptually, this is calculated as the post rights market cap. Kitna hona chahiye? Post rights market cap upon the post rights number of shares. I'm just taking you a step back. Post right number of shares. You want to find the X rights price. X rights means post rights price. Well, you try to find the post rights market capitalization and divide it by the post right number of shares. That's it. Acha, what will be the post rights market capitalization? Well, pre rights you had 10,000 shares and each of these shares were worth 150. After the rights happened, you issued another 2,500 shares, but against that you got some capital. You got a capital of 100 rupees, and hence post rights you have 10,000 plus 2,500 shares. However, pre rights you had a company which was worth 15 lakhs, 10,000 into 150. Even post rights, that business is still there, but over and above that you now also have capital worth 2 lakh 50 with you. So in the numerator you will have 17 lakh 50. Theoretically, if there is no other change, then if your company, your overall business was worth 15 lakhs a day before, then after the day of rights it is still worth 15 lakhs plus another 2 lakh 50 that you have. But now that entire 17 lakh 50 has to be shared between 12,500 shareholders, and hence the value per share will be the same number, that is 140. This is, according to me, what I've done in right, on the right hand side rather, is the best conceptual way to calculate any post issue value. You take the post issue market value of the entire business divided by the total number of shares, and that will give you the X rights price or the post rights price. Institute over here in AS20 as well as IND AS 33 takes a shortcut. Rather than doing it for the entire company, it does it for a shareholder who is going to subscribe one right. So if a shareholder wants to buy one right share, he will have to have 4 existing shares, for which he will have to spend 4 into 150, that is 600 plus 100 into 1, and hence he'll have to spend 700 rupees for getting 5 shares, and hence on an average for one share the value should be 140 after the rights issue. Prior to the rights issue, this was not there. Prior to the rights issue, let us say I was holding 4 shares of 150. That was, my value was 600 for 4 shares, and hence the value per share was 150. However, after the rights, all else remaining constant, I will buy 1 share, the value of which is 100 rupees, and hence post the rights, I have a total value of 700 for 5 shares, and hence the value is 140 per share. This is a theoretical X rights price, post rights price. Achha, second, you calculate what is called as the rights adjustment factor, RAF. Like the bonus adjustment factor, you calculate the rights adjustment factor. Sir, what is the logic behind doing that? I'll explain this to you. Your rights adjustment factor is a fair value prior to the rights in the numerator, prior to the exercise of rights in the numerator, which is a cum rights price, upon the theoretical X rights price in the denominator. So over here, this is equal to 150 upon 140. 150 upon 140, which comes to 1.0714, let us say 1.0714. Sir, what is the point of doing that? Conceptually, you are trying to find the hidden bonus. Sir, kya bol rahe ho? Think of it this way. If you have some understanding of how stock market reacts to a bonus issue, if let us say pre-bonus, the market price was rupees 100, and let us say you had 1000 shares, which means your total market capitalization, as you call it, would be 1 lakh. After bonus, what happens is you now have 2000 shares, 1:1 bonus, so you have 2000 shares. However, if your market price remains the same, then what will happen is your market cap will become 2 lakhs. So companies बोले कि काम करेंगे, धंधा करना ही नहीं है. Every day in the morning we'll wake up and we'll give a bonus share or a share split, and your market cap will keep on going up. No. Here it is just a book entry, and hence the market cap continues to remain the same. This is 1 lakh only. However, then what will undergo a change? 2000, because you have actual shares. Market understands that there has been no real change in the company except for issuing more shares, and as a result the market price undergoes a change. This is rupees 50. So let us say the bonus ratio and all of these data is not given, and you have just been given the pre-bonus price and post-bonus price. So if you divide the pre-bonus and post-bonus price, this will give you 2:1, which is the bonus ratio. Had there been no bonus, you would have still had 1000 shares whose price would still be 100 rupees, and hence the ratio would be 1:1. Because there is a bonus, your price is now coming down to 50 rupees, all else remaining constant, and hence there is a bonus. So bonus can be looked at from looking at the difference in the number of shares or looking at the difference in the price per share. And as a result, what I'm trying to do is you're trying to find the price post the rights and the price pre the rights. Well, if the rights had happened at the fair value, so for example, had the rights happened at 150 rupees only, then to be honest, this would also be 750 upon 5, which will be 150 rupees, and hence the ratio over here would be 150 upon 150, that is 1:1. There would be no bonus. However, because the rights are at a discount and we want to find how much is the element of bonus inside, we can quantify that by looking at these two ratios. So 100 and 50 के basis पे you can figure out that the bonus ratio में how do you calculate the bonus ratio? The pre-shares plus the bonus shares divided by the pre-shares, like we did. In a similar way, what we are doing is, if your share price prior to, let us say this was pre, if your share price prior was 150, then share price later should also be 150. The fact that it is falling, all else remaining constant, is because you are giving a hidden benefit. If there was no hidden benefit, as you saw earlier, if the issue price was 150, then the price would have remained the same, and hence 1.074 includes that 0.0714, which is attributable to the bonus. Very difficult to understand, but agar aapko yaad nahi rehta, you can remember the steps. There are only 3 steps. Step number 1, calculate the theoretical X rights price, that is nothing but the weighted average price. Step number 2, calculate the rights adjustment factor, which is the fair value prior to rights exercise upon the fair value or the theoretical X rights price, not fair value, theoretical, because you are calculating it, X rights price after the share becomes X right. And third, you will multiply the RAF like you used to multiply the bonus adjustment factor. You will multiply RAF to the shares prior to the date of rights, to the shares outstanding prior to, exactly like for bonus. So the bonus adjustment factor in question 3, that was 4:3, you multiplied to 10 lakhs which was outstanding prior to the date of bonus, to 2 lakhs which was outstanding prior to the date of bonus, but you did not multiply it by to 2,50,000 which was after the date of bonus. Similarly, the rights adjustment factor is a hidden bonus, and bonus has to be retrospectively adjusted, and hence you will multiply it to all the shares that are outstanding prior to the date of right, prior to date of right. Acha, if you are still not clear and you want to understand it conceptually, I will make one more attempt using a different method. First, let me just try to find the EPS over here, or try to find the vains over here, in which case the vains would be, you will have 1,000 or 10,000 into 1.0714 into 12 by 12. So this is, let us say, vains for the current year, which is 10,714 into 12 by 12 plus 1250, 10,714 into 12 by 12, that's fine, into 2,500 is the rights, this is 2,500, and hence this is 10,714 plus 2,500, which is 13,214. Acha, remember, bonus has to be retrospectively adjusted, and RAF incorporates a hidden bonus. So over here, let us say this is for the year 2011. However, let us say you wanted to find the vains for 2010. Let us say these were outstanding, let us say from 1st of January 2010, which means if I were to find the vains for 2010, well, we would say there was no fresh issue in 2010, and hence the vains should be the same, 10,000 only. However, bonus has to be retrospectively adjusted, and hence the bonus ratio, like you multiply, you will also multiply the rights into 12 by 12, and hence you will have to calculate a restated EPS based on 10,714, where you are assuming that 714 is a hidden bonus. Sir, kya hai? I'll just try to explain it using an alternative method which generally students tend to understand. Institute does not do this, and hence I would recommend you also don't try this, though you will always get the same answer, but I would avoid this because Institute does not do it. So over here, alternatively, we can say that when you look at right issue proceeds, the right issue proceeds are how much? The rights are happening for a consideration. So what are the issue proceeds? We can say that, well, 2,500 shares at the rate of rupees 100, which means the right issue proceeds are 2,50,000. Acha, theoretically speaking, had you raised this money from the market only, you had not done a rights issue. Had you raised this money from the market only, then at what price would you raise it? Sir, at the fair value. What is the fair value of the share alone? This is where students make a mistake in this method, and hence I don't prefer it, though it is conceptually more strong. What is the fair value? Sir, 150 rupees. Had there been no rights, the fair value would be 150. It is wrong. 150 is the value of the share along with the rights. As a matter of fact, in this case, rights issue has been announced, and as a result, when an investor sells the shares, he gives up the share as well as the right to subscribe the share at a concessional price. Come rights, like come dividend, ex dividend. If you remember, ex dividend price is always lower than the come dividend price. So the come dividend price minus the dividend amount will give you the ex dividend price. In a similar way, over here, the come rights price minus the benefit attributable to the right will give you the ex rights price. So over here, the ex rights price is 140, which is technically 10 rupees lower, which is nothing but this discount of 50 rupees, which is to be spread over 5 shares, and hence on a per share basis, there's a 10 rupees benefit. So a person who is transferring a share prior to the exercise is telling that, well, I'm giving you a right to buy. When you buy, let's say, these shares, you are going to be able to subscribe to the rights, and you are going to be able to subscribe to the rights where you get a 50 rupees benefit for 5 shares, that is a 10 rupees benefit per share, and hence when you are buying the share from me, you have to pay me for the right as well as for the share. The value of the share is only 140. The additional 10 is attributable to the right issue that you have announced. But we are saying that had there been no rights issue, then at what value would you raise these? Well, this would be at the value of the share alone. So the value of the share alone, or also called as the X right price, excluding the value of the right, the value of the share alone. Right to announce हुआ है, इसके लिए price 150 तक jack up हो गया. Had there been no rights, the share would have been at 140 only. The share would have been at 140 only. It is because the right is announced, a shareholder is saying that if I were to sell the share, now I'm giving up the share as well as the right, and hence you have to pay me for the share as well as the right. But now let us assume we are in a hypothetical setup where the right was never announced and you went to the market and issued these shares. You needed 2,50,000 for a project. You issued shares and raised 2,50,000 at the fair price, and hence the shares to be issued at fair value, the shares to be issued at the rate fair value would have been ideally 2,50,000 divided by 140, which would have been 1786 shares are issued for a consideration. You could have raised this 2,50,000 by issuing 1786 shares. However, as a matter of fact, you have issued 2,500 shares. So in the right issue, you have issued 2,500 shares and you have raised 2,50,000 in the process. My point is, you could have raised this 2,50,000 for a fair consideration. You could have issued 1786 shares. So it is as if, listen to this very carefully, it is as if you did an issue of 1786 shares for consideration, and then you did a bonus issue to issue shares for no consideration. You will still be in the same state. So over here you will have 2,500 minus 1786, which will give you exactly the 714 for which we are doing the adjustment. It is as if you are doing 2,500 shares and you are receiving 2,50,000. My point is, you could have raised 2,50,000 by issuing 1786 shares only, and additionally you could have done a 714 bonus issue, in which case you would still be in the same position. So 1786 you will include from the date when they are actually issued, but bonus का 714 जो होता है, that has to be adjusted retrospectively, and that is exactly what we are doing. अगर आपको अभी भी नहीं समझ में आता है, let it go. Do not invest too much of time. No one is going to ask you the logic. You just have to be able to answer correctly, which is by 3 steps. Step number 1, calculate the theoretical X rights price, that is the weighted average price. Step number 2, the rights adjustment factor, that is the fair value prior to rights upon the theoretical X rights price. Third step, multiply the RAF that you have determined to all the share issues that have happened prior to the date of rights, and you are sorted. The logic behind this is you are trying to adjust the hidden bonus, that is 714 shares. These 714 shares have to be retrospectively adjusted from the earliest reported date. Sir, why are they not adjusted later? Because 2,500 includes 1786. It also includes the 714. You don't again add 714, right? If you multiply 1.0714 to this 2,500, it will again include. But here 2,500 mein to 714 already included hai na? And hence you don't have to adjust it again. Okay, so over here you have a rights issue on page number 68. We'll just glance through the theory once. Rights shares are generally issued at a discount to the market price, and hence there would be a hidden bonus in the rights issue along with an element where shares are issued for full consideration. There will be a hidden bonus in our example, which is 714 along with shares issued for full consideration, which is 1786 ideally, which totals up to 2,500. So 2,500 entirely is not bonus, it is not entirely full consideration. As per IND AS 33, bonus shares should be retrospectively adjusted from the earliest reported date, whereas shares issued for consideration should be taken only from the date they are issued. Okay, therefore the following steps need to be followed. Calculate the theoretical, you will not look at the actual price, you are looking at the theoretical price. Theoretically, had there been no other changes, then what should have been the value? X rights price is the shares pre-rights into the pre-rights price. In our example, these were 4 shares. We can take pre-rights for acquiring every 1 right share, 4 shares. The pre-rights price is 150 plus the right shares, that is 1 share, at the rights issue price, that is 100, upon the pre-right shares, that is 4, plus the right share, which is 1. You can also do this on a totality basis. Basically, this is the weighted average price. Step 2, you calculate the rights adjustment factor. It is like the bonus factor. It is like the bonus adjustment factor, where you will take the fair value prior to the date of exercise rights upon the theoretical exercise price. We had discussed the logic that had there been no bonus and had there been the issue of shares for fair consideration, the share price would remain the same. However, in case of bonus, the share price changes, and hence you are trying to infer the price. So for example, if these 2000 shares were issued, there another 1000 shares were issued for consideration, then the company's market cap will also increase, because you now have a higher capital base. So you'll have 2000 shares, but you'll have a 2 lakh rupees market cap, and as a result the price will remain the same. However, if there's a bonus, the number of shares will increase, the market cap will not, and as a result the difference in prices will give you a understanding of the bonus. In a similar way, the difference in prices, that is 150 upon 140, will give you the understanding of bonus. So for example, for your understanding, if you want to try, if this was not 100, if this was merely 10 rupees, if the rights issue price was merely 10 rupees, you would find a much bigger bonus adjustment, because there's a higher bonus. You are giving a huge discount, so you're giving more free. So you will see a 1.0714 se bhi bada number aayega. Okay, third, multiply the RAF, which is there in step 2, to the shares outstanding or issued, ye important hai, prior to the date of exercise of rights. Prior to the date of exercise of rights, no adjustment of RAF needs to be done to the right shares or any other fresh issue after the date of rights, because to the right shares, they already include the bonus, and the shares issued after the date of rights are not in any case entitled to any bonus. Okay, so that takes care of your step number 3. You now go to question number 4 and 5, which are based on similar lines. Let us go through question number 4 and 5. One of these you can mark as important from a revision perspective. Let us say we put question 5 as the important question. So what we can do is we can do question 4 together, and 5 you can pause the video and try on your own, please. Okay, so let us go through this. On 31st December 2011, the issued share capital of the company consisted of 1.8 million ordinary shares of rupees 10 each, fully paid. That's fine. The profits for the year ended 31st December 11 and 12 amounted to 6,30,000 and 8,75,000 respectively. So you'll be given profits for the year ended December. So this is calendar year. On 31st March 12, that is 3 months into the next year, the company made a rights issue on a 1:4 basis at the rate rupees 30. So this is the rights issue price. The market price of the shares immediately before the rights issue exercise, so on the day before the right shares are to be exercised, is rupees 60. Calculate the EPS. So over here you will always try to calculate first the theoretical X rights price. The theoretical X rights price is a weighted average price. We can do this for the entire company based on 1.8 million shares, or you can do it on a per right share basis. So the ratio is 1:4, which means a shareholder has to have 4 shares which are worth rupees 60 in order to acquire 1 share which is worth 30, and hence for a total of 4 plus 1, that is 5 shares, a person would have spent 240, and 30, that is 270, I guess. 270 divided by 5, and as a result this is 270 by 5, which will come to 54. Okay, next you will calculate the rights adjustment factor, the RAF. The rights adjustment factor would be the price prior to rights, that is 60 upon the theoretical X rights price, this is 54, so this is 60 upon 54, which will come to 1.11111, or you can say that this is 10 by 9, for example, whatever it is. You can simplify it, or you can say 1.111 as well. Achha, now you want to find the restated EPS. So over here, for the year 2011, so when was the rights issue done? The rights issue was done on 31st March 2012. So in 2011 there was no rights issue, so this 6,30,000 of profit divided by, if I were to find the restated EPS, will be 1.8 million. This is 18 lakhs into the rights adjustment factor. So this is into 10 by 9, let us say, into 12 by 12. If you take 1.111, there will be some rounding off. So that is also permitted. In your notes, I think 1.111 is taken. So this is going to give you a much more accurate number. So this is 6,30,000 upon, let us say, 18 lakhs into 10 divided by 9, which is 20 lakhs into 12 by 12. So this is 20 lakhs, and as a result this is 6,30,000 divided by 20 lakhs, which will come to 0.315. This is the restated EPS. If you actually go and see in the last year's financials, the reported EPS would be 6,30,000 divided by 18 lakhs, directly 6,30,000 divided by 18 lakhs, which would be 0.35, but the restated EPS for a better comparison would be 0.315. Acha, now comes 2012, which is interesting, where your earnings, I guess, are 8,75,000, and in the current year, right shares have been issued. Acha, when have they been issued? On 31st of March 2012. So over here, you will have 18 lakh shares, which were technically outstanding for the entire year. But these 18 lakh shares have been outstanding prior to the date of rights, and hence there would be a bonus adjustment over here into 10 by 9 into 12 by 12. You can take this. However, if you do this calculation, the problem that will arise over here is, just a second, let me just see what we have done earlier. Have I calculated wins earlier? No. अच्छा, यहाँ पे अपन ने क्या किया, 2000, ये कुछ गड़बड़ करके रखा हुआ है, 2500 into 6 by 12 we have taken. अच्छा, so what this will do is, this will actually do a double counting. This is one place where we would prefer to take the year dividing into two parts. Over here, this would have been okay. ये अपन ने जो किया, यहाँ पे भी एक गलती है. I want to point that mistake out. Till now, things are perfect. Now, when you take 18 lakhs into 10 by 10, please pay attention to this. When you take 18 lakhs into 10 by 9, please pay attention, that is equal to 20 lakhs over here, which is fine in case of 2011. If you take this, this is 20 lakhs, which is outstanding for the entire year. As a matter of fact, there were 18 lakhs, uske upar aapne 2 lakhs add kiya for a hidden bonus. We will also be in a position to back calculate that 2 lakhs if you permit me to do that. But then plus if you do, what I'm doing over here is going to be wrong. And I'll explain you why it is wrong. Plus over here, you will add 18 lakhs into, what is the number of right shares? 18 lakhs into 1 by 4. So this is 1.8 million or 18 lakhs into 1 by 4, which will come to, let's say, 4,50,000. Into, you will not do any rights adjustment. However, into, you will take 9 by 12. So this is outstanding for 9 months. Okay, you will do the calculation and proceed. So this is 20 lakhs into 12 by 12, 4,50,000 into 9 by 12. Without even realizing, you will make a mistake over here. Sir, what is the mistake? If we go to see, like the method that we discussed earlier, how much are the right shares and how much are the rights issue proceed? What are the rights proceed? The rights proceeds, please pay attention over here, would be 1.8 into 1 by 4. So that is 4,50,000 shares you are issuing, and these shares are issued, let us say, at the rate of rupees 30. And as a result, 4,50,000 into 30, that is 1 crore. 35 lakh is the rights issue proceeds. Had you issued it at the rights issue at the fair value, had there been no rights, so had you issued it at the excluding right price, the excluding right price over here is going to be rupees 54, and as a result, the number of shares that you will issue is 1 crore 35 divided by 54, which is 2,50,000. So these 2,50,000 shares would be issued for consideration. However, how many shares have you issued? You have issued a total of 4,50,000 shares. Out of this 4,50,000 shares, we can say that 2,50,000 to SAB we are issuing for a consideration, which means the remaining. So even if I did not issue the entire 4,50,000 shares, even if I had issued only 2,50,000 shares at 54, which would have been the price had there been no rights issue, still I would have been able to raise 1 crore 35, which means the remaining 2 lakh shares are bonus shares which are issued without consideration. Acha. So these 2 lakh shares have to be retrospectively adjusted, which you have in the year 2011 when your shares were 18 lakhs. You took 20 lakhs and hence you retrospectively adjusted the 2 lakhs. Perfect. There is no double counting. 2 lakhs should have been adjusted. It is adjusted. However, when you take 20 lakhs into 12 by 12, listen to this carefully. This is 18 lakhs plus 2 lakhs into 12 by 12 basically. And when you take 4 lakh 50, this is also 2.5 lakhs which is for consideration plus 2 which is bonus into 9 by 12. So can we say that this 2 lakhs is getting counted twice? This is also getting counted in the 18 lakh working, and it is also getting counted in the 4,50,000 working without we realizing it. And hence the way we would have solved it in the usual course, we would have directly taken, हमको समझ में भी नहीं आता था. But now I hope you are understanding that this 2 lakhs is getting counted twice because वो 18 lakhs plus 2 lakhs is 20 lakhs, and that 20 lakhs you are doing a 12 by 12 weight. So you're taking that this 2 lakhs is outstanding for the entire year, and then here instead of taking, I mean you could have taken 2 lakh 50, then it is perfect. These are shares for consideration, but उसके लिए वापस ये सब आपको calculation करना पड़ेगा, जो आपको strike भी नहीं होगा. In which case, when we are taking 4 lakh 50, 4 lakh 50 is the total shares. The shares for consideration, that is 2 lakh 50, as well as the 2 lakhs which are without consideration, and hence you are again counting that 2 lakhs. So what is the better way to do this? In such cases, rather than doing the veins by taking each share separately, you will divide the year into 2 parts. You will divide the year. So rather than doing all of this, what you will do over here is, this is wrong. This is going to give you a wrong answer. What you will do is, chalo, 18 lakhs hai, into, this is outstanding prior to the date of right, so factor will have to be done, but you will multiply it by 3 by 12. Sir, how? Well, we are saying that this 18 lakhs of share capital was there for a period of 3 months, okay, which means in this 3 months, when you do 18 lakhs into 10 by 12, that 2 lakhs that should have been added is added for the first 3 months. Then we say that our total share capital, which was 18 lakhs, will now become 18 lakhs plus 4 lakh 50. That is 22 lakh 50. You are dividing the year into 2 parts. This is nothing but 18 lakhs plus 4 lakh 50. But when we add 4 lakh 50, that 2 lakhs of bonus is already added. So you don't multiply the rights adjustment factor again, but you will multiply this for the remaining 9 months. So what we have done is, we have taken 18 lakhs, we have taken the share capital. जैसे अपन एक alternative method discuss किया था at the starting, we have taken 18 lakhs. We have said that is outstanding for the first 3 months when there was no right share, and then rights shares are issued, that is 4,50,000 shares, and hence 18 plus 4 lakh 50, that comes to 22 lakh 50 is outstanding for the remaining 9 months. So we have not taken the share issues separately. In fact, we have taken the cumulative share capital. We have said that, okay, we want to find a weighted average. For the first 3 months, the share capital was 18 lakhs. For the last 9 months, the share capital was 22 lakh 50. Wherever appropriate, the bonus adjustment was done. And as a result, this will now be 8,75,000 upon, if you go to see, this is 20 lakhs. 18 into 10 by 9 is 20 lakhs. जिसमें 2 lakhs आ गया into 3 by 12. So the bonus shares are included for the first 3 months. So this is 5 lakhs over here, and then 22 lakh 50 already includes 4 lakh 50, जिसके अंदर 2 lakhs already है, into 9 by 12. Sir, हम full confused हो गए. Expected. So over here this is 1687,500, and hence if you total this, this is 8,75,000 upon 21 lakh 87,500, which is, let us say 0.4. हाँ, अभी अपने को थोड़ा confidence है. When we see a round number, it seems to be a little more comforting. So this is 0.4. What do we have to remember in case of a right issue? 3 things. First, you will calculate you will calculate the theoretical X rights price, then the rights adjustment factor, and then you will multiply the RAF to the number of shares outstanding prior to the date of rights. यहाँ पे एक चीज ऐड कर लो, Vains should be calculated on a cumulative basis. Here, so if you want to take each issue separately, then 18 lakhs into 10 by 9 into 12 by 12 you can do, and then you will take only 2 lakh 50 because 2 lakhs has already been taken in that 18 lakhs working, so you will not take it again. Then you will take only 2 lakh 50, you will come to the same conclusion into 9 by 12. But वो फिर 2 lakh 50 निकालने के लिए आपको वापस वर्किंग करना पड़ेगा, उससे अच्छा we prefer to do this on a cumulative basis, and hence we have included a similar sum for your practice as well. So you can pause the video at this point and you can try doing question 5 on your own. Hopefully you should be in a position to get this. The most tricky part of this would be the year when the right is issued, that is 2011. I hope you have tried. Pause the video and tried. If not, we can do this together. Let us see question number 5. Calculate EPS when the profit attributable to ordinary shareholders of the parent entity is given to you as 1100, 1500, 1800. Okay. The shares outstanding before the rights issue is 500 shares. Rights issue is 1 new share for every 5 shares outstanding. So this is 500 into 1 by 5, which is 100. The exercise price is 5 and the date of rights issue is 1st of January. That is when we have announced it, and the last date to exercise the rights is 1st March. This is an important date. During this period, so basically between 1st January to 31st March, if someone is buying and selling the share, they will be sold on a cum right basis, which means a person is going to give up the share along with the right to subscribe. So this is the 1st March is the relevant date. The market price of one ordinary share immediately before the exercise of rights, that is on 1st of March. This is before the exercise of the right, is 11 rupees. This is what you call as the cum right price, because even if at this stage you were to sell the share, the buyer is in a position to get the share as well as an ability to subscribe to the rights, and hence what you are selling is the share along with the rights. The reporting date is 31st December. What do we have to do? We have to find the EPS. So over here you will first try to calculate the theoretical X rights price, which is, the price is 11 rupees and you will have to buy 5 shares of 11 and then 1 share of rupees 5. Exercise price is 1 in order to exercise price is 5. So for a total of 5 plus 1, that is 6 shares, you will end up spending 60 rupees, and hence the theoretical X rights price, let us say, is going to be 10. Now the rights adjustment factor, ideally had there been no rights, the price is the price after the rights is 11 and the X rights price is 10, and hence 1.10 or 1.1 is the rights adjustment factor. So probably 0.1 is the bonus, in which case over here you will have to find the Vains. The number of shares are 500. So if you go to see the Vains for the year 2010, which is prior to the rights, would be 500 into 1.10 directly. So this is 550. When we look at the year 2010, this is the 2011, this is a year when the rights have been given. So you will do this on a cumulative basis. So we will say that for Vains calculation, let us say there are 500 shares which were outstanding for the first 2 months, that is January and February, and in 1st March the shares are exercised. So you'll do a 1.1 adjustment and then into a 2 by 12. This is where students make a mistake. And then you will take 500 plus 100, that is 600 shares. No rights adjustment factor for the remaining 10 months. Sir, why no adjustment for bonus? Because ये 600 के अंदर bonus 100 included है ना, 100 के अंदर whatever is a bonus shares are already included. So this is 550 into 2 by 12 plus 600 into 10 by 12, which will come to 500 into, let us say, 1.1. So this is 550 into 2 by 12 and 600 into 10 by 12. And hence this is 591.67. And 2012 is after the rights issue, and hence you will not multiply the RAF, the entire 600 shares, into 12 by 12. So this will be 600. So basically, if you want to find the basic EPS, you will divide this by weighted average number of equity shares, which will be 550, which will be 591.67, and which will be 600. So over here you will have, let us say, let me just verify this once. So this will be 1100 divided by 550, which comes to 2 rupees. So basic EPS is 2. 1500 divided by 591.67. So your EPS is 2.535. This is 2.535. And for 2012 it is 3. So these are your 3 numbers. I hope you have got this correct. The reported EPS, if you open the last year's report, would have been 1100 divided by 500, and hence it might be 2.2, but the restated EPS is actually 2. Okay, so that takes care of question number 5. You can practice this once again to get a better understanding. So I guess we can stop for the day, and we'll continue with the additional part in the next lecture tomorrow. Okay, so thank you very much for your time, and I'll see you tomorrow with IND AS 33. Bye bye. Take care.